Welcome to Taking Stock for the week ending the 30th July 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. As reporting season begins, one thing we'll be watching very closely is this extension of Sydney's lockdowns and the impact this will have on the outlook for cyclical star stocks. For example, Commonwealth Bank, they will be reporting, and although we expect them to issue a share buyback similar to those from ANZ and National Australia Bank, or even a special dividend, the lockdown extension will mean a rise in COVID provisions, which in turn could affect the dividend expectations going forward. This risk also could impact other stocks, including Credit Corp, Waypoint Property, and Lovisa as well. But the majority of stocks at risk of lockdown extensions are those in unhealthy businesses in travel, tourism, and hospitality, which may need to raise equity to continue to operate. As long as this risk lingers, defensive growth stocks like those in healthcare, such as CSL, Fish and Pike, or ResMed, or consumer staples like Woolworths, Coles, or even food delivery stocks like Collins Foods and Domino's, they should perform well.
Yeah, another issue that has concerned investors over the week has been inflation data, which showed a 3.8% spike in domestic annual inflation rate and was well above the Reserve Bank of Australia's target range of 2 to 3%. This was driven by higher petrol prices and supply chain disruptions. But recent lockdowns mean that the RBA will unlikely change its stance on interest rates. Interestingly, the futures market is pricing in a rate increase as early as August 2022. Once again, we remind investors not to be concerned because low and rising interest rates tend to be positive for equity markets because it does reflect stronger economic growth.
Yes, Jake, the RBA does believe the inflation data is transitory and will normalise over time. But we've just gone through another period of mining quarterlies, and so far production volumes have been mostly in line with market expectations. And among the bulk producers, Fortescue Metals, they indicated that they've shipped 182 million tonnes of iron ore in financial year 21, and that's an increase of 2% from the prior year and slightly exceeding guidance as well. And with iron ore prices at elevated levels, this should help drive earnings growth in financial year 21 beyond that 100% level. The company is also aiming to ship up to 185 million tonnes in financial year 22, but has flagged that cost could be 11% higher. And this is one of the reasons why earnings growth is expected to slow in financial year 22.
Yeah, and interestingly, Fortescue has moved from having 1 billion in net debt to a cash position of 2.7 billion at the end of the June quarter, making it financially strong in health. Exploration costs are expected to fall by about 17% in FY22, and this should help support free cash flow and dividend payments for the year ahead. With ample cash on the balance sheet, the company can afford to pay dividends above its level of free cash flow, with the gross dividend yield over 19% and an ex-date about 42 days away.
Yes, and this dividend theme has been consistent with other iron ore producers as well, namely Rio Tinto, which reported better than expected first half earnings results over the week. The company is expected to pay shareholders $5.61 US in total dividends for the half, which was well above market expectations. Rio is on track to pay a gross dividend yield of over 18% for investors in financial year 21, with the ex-dividend date only about 13 days away.
Yeah, and somewhat ironically, the strong result was driven by elevated iron ore prices, driven by weaker supply from Rio and Brazilian mine Vale. In fact, first half shipments were down 3% on the previous year due to labour shortages, extreme weather, and a renewed focus around restrictions on mining Aboriginal heritage sites. The company does expect full year shipments to be at the low end of the earlier estimates of 325 to 340 million tonnes. But with elevated iron ore prices, this does not appear to matter as much.
Yes, but with many of these non-traditional income stocks, we do need to be mindful that iron ore prices could be forming a peak in the cycle, and we will be monitoring earnings revisions for these stocks in the following months, especially with regards to the negative earnings growth expectations in financial year 22. Positively though, Rio, along with its peers like BHP, are actively finding new sources of growth in sectors such as battery materials. In fact, Rio said it was willing to spend up to 2.4 billion US dollars to build a new lithium and borates mine in Serbia.
Yeah, and relating to the topic of iron ore, we had a positive trading update from Bluescope Steel, a steel and building products producer. The company upgraded its second half earnings guidance by about 14% due to a strong US hot rolled coil steel prices and higher than expected domestic demand, as well as a widening spread between steel prices and the required raw materials that are used to make steel. For clients who are unfamiliar with the steel industry, hot rolled coil steel is widely used in vehicle appliance and agriculture equipment manufacturing, where demand has been spurred by government stimulus. Beyond FY21, earnings growth is set to continue, driven by strong demand for motor vehicles and infrastructure projects globally. In addition, analyst steel price forecasts are still well below current realised levels.
And moving on from resources to financials, Macquarie Group said its first quarter trading profit was well above the prior year due to the absence of large COVID provisions, bad debt provisions, high investment income as well from the commodities market, and also the sale of its industrial smart meter business in the UK. Nevertheless, the company warned that it would reduce its dividend payout ratio from 60 to 80% to 50 to 70% to conserve that capital in response to intervention by APRA with regards to multiple liquidity standard breaches. This may lead to a reduction in dividend expectations, with the company currently on a forward gross dividend yield of 4%. But we will be monitoring its income status in coming months. On the positive side, though, the additional capital will support its financial health rating, with its bank common equity tier 1 ratio at 12.1%, plus they've got an additional 7.4 billion in surplus capital.
Over the last few weeks, we've spoken about the strong levels of merger and acquisition activity, and borderline star growth stock Iress, a portfolio management software platform for the wealth management industry, has knocked back a second takeover offer from private equity firm EQT for around $15.50 per share, stating that did not represent good value to shareholders. The company has also announced an on-market share buyback of up to $100 million, which will be used to reduce the number of shares by about 3 to 4%. Positively, along with the positive trading update, the company anticipates revenue growth to be in the range of 10 to 11% per annum over the next 5 years. And with the share buyback, we expect analyst upgrades to flow through to the forecast return on equity and earnings growth.
Also, in the mergers and acquisition space, Spark Infrastructure, a company that owns and manages a portfolio of electricity infrastructure assets in Victoria, New South Wales, and South Australia, they've received an increased bid from $2.80 per share to $2.95 per share from a consortium. The offer appears reasonable, but is subject to due diligence by the consortium. Income investors should be delighted with the capital gains in their holdings. Even at the current price, Spark is expected to pay investors a gross dividend yield in excess of 5%, with future operating cash flows expected to cover distributions. Also, unfortunately, Australian pharmaceutical industries, the code is API there, has rejected Wesfarmers' takeover proposal for $1.38 per share. Now, the purpose of the acquisition was so that the Wesfarmers could take advantage of the growth potential in the health, wellness, and beauty sectors. But this acquisition is small, representing only about 1% of Wesfarmers' market cap.
Now, with the start of reporting season, let's turn our attention to the corporate calendar. Companies expected to announce results next week include Credit Corp, BWP Trust, GUD Holdings, Pinnacle Investments, Nick Scali, ResMed, and REA Group. And for the trend-sensitive investors, Seven Group turned bullish on the SD Max over the week.
For Under the Microscope this week, we focus on our star fund managers that have been exposed to heightened active risks with regards to changes to China regulations. There are now heightened regulatory risks in China, with Chinese officials revealing an overhaul of its private education sector, forcing education companies to operate on a not-for-profit basis. This follows on from existing regulatory restrictions for large Chinese technology firms such as Alibaba or Tencent due to perceived anti-monopolistic behaviours. The Chinese stock market has felt the brunt of the newly introduced regulations, resulting in poor share market performance since the start of 2021.
Of course, the issue has translated to recent weakness in the share prices of our star fund managers, Platinum Asset Management, PTM, and Magellan Financial Group, MFG, who both manage Asian stocks. On a cumulative basis, Magellan has 10% of its funds exposed to China, with direct exposures to both Chinese corporates Alibaba and Tencent, while Platinum has 20% of its funds exposed to China. Remember, fund managers tend to pay out most of their earnings in distributions with forward payout ratios in excess of 90%. Therefore, a decline in earnings due to this active risk will also impact the future dividend sustainability. Currently, Platinum and Magellan are on forward gross dividend yields of 8.8% and 5.6% respectively.
Yeah, that's interesting, Jake. But investors need to be mindful that that higher dividend yield for Platinum implies it has higher risk because it has more China exposure. Unlike Magellan also, earnings growth for the year ahead for Platinum is expected to be negative. And to compound things further, its funds have tracked below benchmark over the month, mainly due on the back of this rotation back towards growth stocks from cyclical value. Remember that Platinum is exposed to those economically sensitive value stocks. Hence, investors should be mindful of their exposures to these fund managers, especially leading into their results. As we enter the reporting season, a good question for investors this week is, how do I know whether I should buy into the stock before they report? Reporting season is among the most volatile periods for equities. So before you even think about buying or selling stocks, you need to make sure you are well diversified. For example, have at least 15 stocks in your portfolio to manage the idiosyncratic risks. You can use the portfolio director and optimizer to ensure you are not too concentrated in any higher risk exposures.
Often a positive or negative earnings surprise in their very nature are difficult to predict. So it is a high risk strategy to position yourself into a stock before they report. But Stock Doctor can help you minimize these risks. Firstly, track the past earnings announcements and share price reactions when you click on More under Golden Rule 8. A stock is unlikely to announce a negative surprise if there has been a positive trading update recently. Take, for example, JB Hi-Fi with its better than expected earnings guidance. Monitor the earnings risks as the stock heads into the result. If the share price is trending lower and our analysts have been updating their commentary with heightened active risks, then take a note of this. If you are not comfortable with the risks, then remove your exposure. A good example of this is with Platinum Asset Management and Magellan Financial Group with their exposure to the regulatory crackdown in the Chinese markets.
That's right, Jack, and pay attention to the share price under Golden Rule 4. If the share price is elevated, then it's most likely that the market would have factored in a positive result. In this case, it would probably be more prudent to take some profits off the table. Also, look at the trend in the short interest in recent months. If this trend is rising, then there is high risk of negative share price reactions. And under Golden Rule 7 as well, monitor whether there has been director selling in recent months.
Yeah, for income investors, there is little risk in positioning yourself into defensive income stocks like real estate investment trusts and utilities because these stocks tend to meet expectations. Alternatively, for the majority of stocks, wait until the company reports and assess its financial health. If it's a star stock, read our final analysis. There is usually 2 days of strong price reactions following a result before the prices start to consolidate, and often investors can position themselves during this consolidation period. Of course, if you are trend sensitive, then you'll need to sell or buy the stock if it triggers your stop loss on the SD30 TSR or if it changes trend on the SD Max.
Okay, I think that's all we have time for today. And thanks, Jake, for your insights.
Thanks for having me on again, Kien.
So as reporting season begins, we want to remind investors about the importance of risk management during this period where equities are more volatile. Use Stock Doctor to track your portfolio exposures, making sure they are not too exposed to heightened risk leading into their results. Track the share price sentiment, management holdings, the short interest, earnings updates as well, and be sure to contact the analyst if you do not fully understand the active risks. Take care and have a happy, healthy, and prosperous week, everyone.